we might be on the verge of experiencing the loudest pop in the history of the global stock market.
What is next for stocks?
About the market next year. He says 2024 is going to bring, and I'm quoting him now,
is the market nearing bubble territory, and how should you
As the bubble inflates, the world holds its breath. Investors are glued to the glowing stock tickers on their devices. Spectators and analysts worldwide gripped by suspense, all because of one word: AI. Conversations around a possible AI stock market bubble can be traced back from late 2021 to early 2022, aligning with significant stock growth of major AI companies like Nvidia, Microsoft, OpenAI, and the likes. Now fast forward to 2023, and you've got YouTubers shouting from the rooftops, rallying their viewers, prompting more interest in the topic.
The leading AI stock, which is Nvidia, is now the fourth most valuable asset in the entire world, valued at over
$1,000 into
trillion.
Nvidia stock. At the peak in March, you would have 215,000.
Large global companies pivoting into AI at a lightning pace so as to be first out of the gate in this new money-printing opportunity. And even large news and media organizations guzzling up engagement and watch time with ever more outlandish and hyperbolic talking points on the AI stock bubble, and indeed, the wider AI industry as a whole, driving yet more fascination and fear with this growing field of investment. With notable analysts arguing for and against a possible ongoing bubble inflation, do we have cause to head for the hills? Or is this a mere baby bubble, as analysts at the Bank of America call it? Let's dive in and find out. To better grasp what the AI stock market bubble entails, we first need to understand what a stock market bubble is. After that, we'll take a quick peek at a few significant stock market bubbles we've had in the past. Quick note, if you'd like to skip to a specific section of this video, we've got timestamps in the description to help you navigate effectively. We've also dropped some links you'll find useful to help you better understand the AI stock market bubble in a bit more detail. Now, what are stock market bubbles? According to this article on Forbes, a stock market bubble happens when the price of a stock or an asset rises exponentially over a period of time far above its genuine intrinsic value. That last bit is the real kicker. Eventually, prices get to a point where they are so much higher than their actual real-world worth that the stock price becomes critically unsustainable and therefore unsellable. The asset almost instantly goes from being worth a pretty penny to essentially worth nothing. After all, what good is something you can't ever sell? And it all comes crashing down with vicious ripple effects throughout the market. It's quite similar to what happens at an auction if people get into a bidding war and wind up driving the price of an item way above its actual worth. The only difference is, auctions are not known for potentially crashing the global economy. Let's break it down by using a simple analogy. Imagine a trendy new sneaker hits the market. Everyone wants these limited edition shoes. Demand is through the roof, so prices go crazy high. Seeing just how valuable these shoes are becoming, a ton of other shoe stores get in on the action and stock up. Shoe stores up and down the country are full of these sneakers. It costs them a bomb to buy these shoes, but it's worth it as they sell for a bucket load too. But suddenly, the hype dies down. The shoes are yesterday's news and now seen as just any other sneaker. You can say the perceived value of the sneakers has gone from really high to average, maybe even lower because everyone's wearing them. They're nothing special anymore. But our shoe stores, they've got a problem. They've paid through the nose for these things, and they have to sell them on at an equally high price just to break even. Problem is, nobody wants to pay that much anymore. Now you've got shoe stores who can't sell their stock, who've burnt through all their money purchasing these shoes, possibly going broke, laying off staff, people out of work, and even shoe suppliers who stock these shoe stores starting to see a massive drop in their income too, as companies fold and go under. It all gets a bit financially nasty. That's a stock market bubble. Prices soar based on excitement, then crash when reality sets in. All stock market bubbles happen in the same four-step manner. 1. Something exciting happens, causing interest to go up. 2. Prices start to go up, higher and higher. 3. The bubble inflates and people begin to buy out of impulse. 4. Boom! Everything comes crashing down. People who enter the market while the third phase is ongoing are definitely going to lose a ton of money. If you're familiar with cryptocurrencies and meme tokens, chances are you've seen this play out over and over again. Now that we have a background knowledge on what stock market bubbles are, let's briefly check out significant bubbles in history. To avoid making this video any longer than it already is, we'll just pick 6 of the most interesting ones. The first stock market bubble on our list started with this. Yup, this is a tulip bulb. Now, stay with me here. In the 17th century in the Netherlands, this plant had just found its way into Europe, and owning one signified access to the international trade routes. Because of this, it quickly became a sort of status symbol. At some point in 1637, the prices skyrocketed to insane levels, even surpassing the price of a small house. Insane, isn't it? Eventually, fewer people were willing to pay the outrageous prices, and of course, panic set in. Prices plummeted so hard that it forms the historic event we now refer to as the Dutch Tulip Mania of 1637. Second on our list can be traced to the 18th century. It all started with a joint stock company called the South Sea Company, founded in 1711 and aimed specifically at carrying out the now abolished slave trade with Spanish America. When King George I became governor in 1718, the company gained an extra layer of legitimacy because of his involvement. Lots of investors began to entrust the company with their money because the king served as a marketing tool, generating interest and, most importantly, a sense of very reliable security in the investment. However, in 1720, things were about to go wild when the company proposed to take over Britain's national debt. It went even further to promise shareholders and investors a share of future profits from the arrangement. Well, eventually people realized that the company was being gratuitously overambitious and began to sell off their shares as quickly as they could. Predictably, a huge crash followed, and Britain's economy took a major hit for it. This chain of events is now what we refer to as the South Sea Bubble of 1720. Third on our list happened in the 19th century, when a major hype was created around the potential of a new transportation method in Britain: transportation via canals. The success of the existing canals, like the Bridgewater Canal, sparked a lot of excitement about the future potential for profits. Investors, eager to get rich quick, poured money into proposals for new canals, many with dubious routes and inflated benefits. As history will have it, investors of course eventually began to realize that many of these proposed canals were entirely impractical and completely unnecessary. What do you expect happened next? If you said very, very nasty financial things, well then you're bob on the money. Or what's left of the money, that is. Which really wasn't much. Predictably, as the realization set in that the vast majority of these canals would be a horrifically poor investment choice, investors across the board dumped their stocks and shares, resulting in the fiscal Grim Reaper, that is, the domino effect. The British economy once again was sent reeling from the blow, and this event gains the dubious honor of being remembered as the British Canal Mania of 1825. Fourth on our list is famously known as the Great Crash. It happened in the early 20th century. We're talking, of course, about the Wall Street crash of 1929. It happened as a result of several different factors, some of which included soaring stock prices, fueled by easy access to credit, overvalued market stocks, a hike in interest rates, panic selling by investors who feared a huge correction, and boy were they proven right. Finally, a weak underlying economy. The crash marked the beginning of the Great Depression, a severe economic downturn that lasted throughout the 1930s. Fifth on our list is one of the direct causes of the lost generation in Japan. The Plaza Accord of 1985, which was signed by the G5 nations France, Germany, Japan, the UK, and the US, was originally made specifically to weaken the dollar in relation to the Japanese yen and the German Deutschmark. Unfortunately, however, the complete reverse happened, causing the weakening of the Japanese yen. Although the Bank of Japan had a bigger share in the blame for this. The Bank of Japan lowered interest rates, which made borrowing cheaper. Poor regulations made it easy for anyone to open a company and file for a loan, with an almost certain approval. Landmark corruption in the government, amid several other factors contributing to making stock prices, which were now off the roof, plummet. It was an absolute disaster. To this day, it is said that Japan still feels the impact of this particular economic mess. It is referred to as the Japanese asset price bubble of the 1980s. The final historic market bubble on our list is the famous dot-com bubble of the 1990s. We can name a barrage of reasons for the crash that happened, but here are the most notable of them all. The quick rise of the internet, abundant venture capital, investor frenzy thanks to the media, focus on user growth over profits by dot-com companies, low interest rates leading to easier access to credit. This particular burst had its good sides though. It hurt several investors, however it also led to a more mature internet economy and the long-term success of established companies like Amazon and eBay, who navigated the bubble and emerged from it stronger. So, here we are in 2024, and analysts are already talking about the next big bubble from this $10 trillion market, and that's exactly what you've been waiting for. So without further ado, drum roll, the AI stock market bubble. As we've established at the start of this video, arguments around the AI stock market bubble are like two sides of a coin. One side believes the bubble is already upon us, while the other believes that we still have what's known as a baby bubble. To have a better understanding of what's going on, we have to look below the surface. Before we start, we need to understand that analysts are never 100% accurate and should not be treated like prophets. Let's take a quick look at exactly what analysts do to put things in a better perspective. 1. They interpret historical data and attempt to posit what the future holds. 2. They are not soothsayers. 3. They base their prediction on the factors that arise at the time of analysis. With that settled, let's get into the source of our topic. We'll pick one major argument from each side, coming from an authority figure with a proven track record. Let's start with the argument that says the AI stock market bubble is already upon us. For that, we look to this guy. This is James E. Demmert, Chief Investment Officer at Main Street Research. He is the author of 3 award-winning investment and finance books, Journey to Wealth, The Sustainable Endowment, and his latest publication, Wall Street Lessons. To check out more details about him, you can visit his website at jamesdemmert.com. In an interview, Demmert was asked about the AI stock market and what he sees in the future, and he had quite a lot to say. Amongst all his words, we picked out 2 astonishing statements. 1. He says that the adrenaline-pumping hunger for AI stocks is a temporary phenomenon, driven by irrational exuberance rather than fundamentals. In his own words, the recent market strength is being driven by FOMO for both retail and institutional investors. For those who are not familiar with the term FOMO, it simply means fear of missing out. 2. In an interview with Market Insider, he said the following words when asked about the same topic, and I quote, "We do not think the daily grind upwards in the stock indices is sustainable." Largely amid the possibility of mixed earning reports over the next few weeks and the possibility of yet another Fed rate hike. Now, does his argument hold any weight? Well, of course it does. We know that for any buyable asset to have sustainable unit value, it needs to grow slowly and steadily with fundamentals, and not mere speculation. FOMO pushes investors to rush into the market with funds, and most of these investors barely have any understanding of exactly what they are investing in. According to Demmert, these kinds of investors are flooding the space right now. And if this trend continues, then we might just be heading for a major catastrophe. However, some conditions must be met first for those to happen. Bear that in mind. We will talk about it a little bit later on in this video. For more on his take on the AI stock market bubble, check out this article displayed on your screen. You can also find it in the description below this video. Other analysts who support Demmert's position also cited the rapid growth of specific companies like Apple, Tesla, Nvidia, and high valuations relative to earnings. So, do you also support Demmert's position? Let us know in the comments below. We'd absolutely love to hear from you. The most well-structured argument against Demmert's position, in our opinion, was put together beautifully by this guy. This is Raymond Thomas Dalio, an American investor and co-chief investment officer at the world's largest hedge fund called Bridgewater Associates. He has served in this capacity since 1985, almost 39 years at the time of making this video. He is also a #1 New York Times best-selling author of not one, but 3 books: Principles, Life and Work, Principles for Dealing with the Changing World Order, and Principles for Navigating Big Debt Crises. He has experienced stock market bubbles before and is considered an authority in his field. He made a detailed analysis in his work uploaded to his official LinkedIn page, titled, "Are We in a Stock Market Bubble?" He cited his reasons to believe that we are in a relatively small bubble with huge potential. He started his work by first defining exactly what a bubble is, and went further to list the conditions that a market has to meet before the period could be referred to as a bubble. He mentioned high prices relative to traditional measures of value, unsustainable conditions, inflow of naive buyers, broad bullish sentiment, or in other words, traders are optimistic and believe that the market and individual assets will increase in value as time goes on, a high percentage of purchases being financed by debt, and a lot of forward and speculative purchases made in expectation of price gains. With all these criteria set, he said, and I quote, "When I look at the US stock market using these criteria, it, and even some of the parts that have rallied the most and gotten the most media attention, doesn't look very bubbly." This means that the stock market has not satisfied the requirement listed to qualify as a bubble. He showed 3 charts to further explain his position. The first chart shows the 1920s bubble. You can also see that of the 1990s dot-com bubble. Then compare these charts side by side. Does it look like an upcoming plummet to you? And does this hot take surprise you? Or was it what you're expecting? Drop your answers in the comments below. Dalio's work would take an entire video to dissect, so if you're interested in going through his full work on LinkedIn, there's a link down in the description to take you straight to it. Now, let's wrap this up. At the end of the day, Analysts only work with the data they have available to them. Do we know the future for certain? Well, of course not. People in the 1990s who experienced the dot-com crash probably didn't wake up every morning expecting things to go south. Major market crashes usually take people by surprise. However, the case of AI is quite unique. AI is slowly being integrated into almost every aspect of our lives. It has practical use cases, and many companies are willing to get the hardware needed to make the integration happen. I mean, no wonder companies like Nvidia keep smiling to the bank. The current usefulness of AI can also be seen in the trends that most major tech companies are beginning to follow. A good example would be Meta's switch from the metaverse to AI. When large corporations like that begin to make such bold moves, that's your cue to consider safe actions to take. Now, what should you do with this information? Firstly, we would like to state that we do not give financial advice on Fiscal Compass, but rather equip you with the knowledge you need to make your own decisions. This video is for entertainment and informational purposes only, so please do bear that in mind and be safe and sensible with your funds. Now, obligatory and thoroughly boring disclaimer out of the way, we move on to the good stuff. To help you make better decisions, here are some tips. 1. Understand the use case of AI and its future projections. Then juxtapose that with what you see happening today. 2. Learn about the technological limitations of AI. To help you out on this, we've dropped a link to a detailed article below, Understanding the Limitations of AI by Mark Levis. He did an excellent job simplifying this enough for anyone to feel like a true expert after reading it. It's there for you to check out. 3. Think tactically, but also time sensitively. If you're going to invest, then invest on time. But whatever you do, don't FOMO invest. Make your decisions based on data, facts, and figures, not speculation and hype. 4. Never go all in. Any investment coach will always tell you never to go all in. This is simply because of the stakes involved. You could go all in and make a ton of cash, but do you really want to imagine the alternative? 5. And most importantly, keep watching Fiscal Compass for more insightful topics and information. If you feel like we've earned it, we would be so grateful for a like on this video, and would love to see you subscribe and join us for future videos too. We've got some real exciting topics lined up, which we can't wait to share with you all. A question for you. Do you have information concerning the AI stock market bubble that we didn't cover? If you do, drop it in the comments below. You might just be helping someone out there to make the right decisions. And, as always, we are your Fiscal Compass.